We're also talking a little bit about there might be lower return expectations today rationally, but there could also be irrational return expectations, and you could also have lower return expectations and an acquiescence to increased risk. So how are your clients, your managers, how are they looking at the risk-return trade-off today versus, say, 3 years ago?
Well, as I mentioned earlier, we've seen sort of the continuation of a trend toward a lot more away from the domestic equities markets into less liquid, well, illiquid classes, fixed income, and emerging markets. And I think one of the things that, from an investment perspective, most people will look at this at the total portfolio level and look at the advantages to diversifying across all these different asset classes. And the math works out pretty well. Again, from my perspective, the thing that you want to be careful not to miss is the operational and regulatory risk that comes with exploring these strategies, because everyone has the same set of features: more complex systems, more difficult regulations to deal with, often vastly underdeveloped infrastructures and market practices in the markets that these strategies are playing out in.
So I'll also make a comment that there's been a real shift in the last 2.5 years by hedge funds away from illiquid. So everybody learned their lesson. Everybody came out of 2008. If a fund had a significant drawdown, they said, well, that was because of my illiquids, and I'm never going to do that again, et cetera, et cetera. The net result of which has been, right now, the biggest opportunity set from a risk-return point of view, I think, is in illiquids, because nobody wants to touch them anymore. So, private lending, private equity, real estate, right? That probably has a very interesting risk-return dynamic right now. So there's a huge temptation, I think, in the hedge fund industry to maybe consider doing some of those things again. So one of the things that we're watching is to make sure, great, if a hedge fund complex, if a firm wants to participate, awesome, do it in another environment. So set up a private equity style fund, set up a more illiquid fund where terms sort of match what it is that you're doing, and sort of keep the real hedge fund underlying hedge sort of pure and more liquid.
Caxton found had some big issues with this in the sort of 05, 06, 07 period, because market vols were so low that to take a lot of risk, you had to have very large notional positions. And we were reluctant we scaled up some, reflecting the lower market volatility in terms of our notionals, but we were reluctant to scale up as much as vol had collapsed. And the reason for that was basically stress test losses, which were alluded to in the previous session. So we were concerned about stress losses. Some other funds maybe were a little less concerned and ended up paying a price for it. But as a result, we had a lot of feedback from investors that your returns are too low. Your risk-adjusted return is fine, but your absolute return is too low. And to get that absolute return up, we would have been perfectly happy with the day-to-day volatility, even the month-to-month volatility. But we would have been unhappy, and we think our investors would have been unhappy with the potential, once every few years stress loss. So that's a challenge. Right now, though, the conditions are fine from that perspective. They're almost ideal, because market vols are a lot higher still than they were in 05, 06, 07, early 07, and plenty high to generate decent returns without ridiculous stress losses in liquid products. I have some concern that a couple of years from now we might find ourselves back in more of an 05, 06 situation, but we're not there yet.
Michelle?
Yeah, wearing my institutional investor hat, I have some concerns. I think that there's a lot of talk about risk, but a lot of people still believe in the tooth fairy. And the way the tooth fairy appears in our industry is with an assumption of too high returns. And then what I'm worried about is that the underlying institutions come a cropper at some point. because I've seen some, poor arguments made in front of investment committees. Oh, you need to be in this asset class because you're not going to get the level of returns from these traditional classes, therefore you need to go here. My other big bugbear when I sit on the committees is, everyone is always looking at their peer group and, very benchmark driven. Over the last few weeks, we've seen a lot of the major universities report their endowment returns, and it's like, oh, yay, we did 90 beeps better than someone else. I think what a lot of the investors need to do is start at it from a budgeting point of view. What's the fund's position within the institution, place a price on liquidity. One of my alma maters is Stanford University because of where it is. One of the things the university always has to have is an earthquake fund. Now, 2008 wasn't actually an earthquake, but thank heavens that fund was there. So you've got to look at particular situations and make sure, your cash isn't going to earn you a lot, but it is there for a reason.
That's great. It's good to hear the perspective from the investor side, from the institutional investor side, about how, do you think perhaps institutional investors are now a lot more aware of risk outside of pure volatility?
They certainly speak the word more often. Whether there's a deeper understanding, I'm not sure.
Let's talk, we did talk a little bit about leverage slipping up, and at the same time we talked a little bit about how with perhaps proprietary trading desks going away, that money's going to go somewhere. So can we talk a little bit about both leverage and the kind of new strategies for prop trading? Mike?
So 2009 for the hedge fund industry was a great year and made people feel better about 2008. Some funds were able to reclaim losses, other funds were not. But the point is there was a very different feeling, I think, towards the end of 2009 versus the beginning of that year. Leverage is something that we have watched very carefully, and it continues to ratchet back up, I think, throughout the industry. The good and the bad news, I guess, depending on whose side you're looking at it from, is prop desks, which one could argue, if you look at the numbers, if prop desks are running possibly twice the amount of assets, so on an asset basis post leverage, so prop desks are running roughly twice what hedge funds are running. If that number goes away, hopefully in an orderly fashion over the next few years, then hopefully that means more opportunity for hedge funds. Now, one of the big open questions is, well, what happens to that capital? What happens to the opportunity? Where does that investment dollar go? Some of that investment dollar will probably follow the prop traders to wherever they start up their own new hedge funds. I have a feeling that probably a greater share will probably go to the top 100 hedge funds that already exist. In that, I think clients or investors are in a mindset where they'd rather not take the operational risk of a startup, because that's where everything is most concentrated and most dangerous, and work with somebody who is well established and has a proven track record. So that is my prediction for where the majority of that dollar goes.
I thought prop trading never made much sense, and the reason is basically the corporate tax. If you're doing prop trading in a bank as opposed to an asset manager, the institution pays corporate taxes on the net gains of that activity, and that's a big wedge to overcome. Even if you have some benefits of seeing some of the flow or something. So I think the main reason why prop trading persisted despite this economic disadvantage was that institutionally it was in the interest of the executives of the firm to have that profit in their institution. It was not in the interest of the owners of the firm, the investors, to have that there. So I think there's a lot of reasons that are now coming together to push prop trading out of banks. And I think the investors should really welcome that and push the banks to do that, and not just because the regulators are doing it. I mean, it's in the interest of the investors that money be. Now, whether it's in the interest of the households who would benefit from the corporate income tax, that's another issue. But they're probably not going to be organized on this issue. So I think it's happening. It's going to continue to happen. There are plenty of good reasons to expect that even if regulatory pressure is less intense, it'll still continue to happen. And the hedge funds are getting better and better at becoming institutionalized and providing assurances. And that was clearly one area where, if you're dealing with hedge funds, you have to worry a little bit about, well, am I going to get my money back? And those considerations have been more acute recently. So as hedge funds improve on that front, and the banks, the hedge funds have also, I think, always been better at managing prop trading, right? So the banks have a disadvantage there at the margin as well.
By taking that money and putting it into established hedge funds and established strategies, rather than the prop trading that was making money doing it previously, do you think perhaps investors might be trading the operational risk of the startup for the capacity problems that might exist in dumping twice as much money into hedge fund strategies?
As I said, I think the hedge fund startups are from an operational perspective, require the most amount of work. The number of diligence hours is pretty extreme for someone with no track record, walking into their first hedge fund. So I think if someone is going to participate in that market, size it correctly and do your homework.
Yeah, but surely one of the lessons we learned from Madoff was that just because a fund has been around for a while doesn't mean that everything is okay, and that the bigger the size, the more impact on the overall financial markets.
Brian, do you have a comment on that?
Well, yeah, I think one of the lessons from Madoff and what we've been talking about a little bit is you just really need to do your homework on this stuff. And in hindsight, it always seems obvious when they don't have an established custodian or pricing vendor. The assets, nobody's bothering to check if the assets are actually where they think they are. I think more generally, one of the things that's interesting to me, and you mentioned it earlier, and I didn't respond, but on the currency markets, as traditionally that's been one of the most opaque prop desk sorts of activities that banks have had for years and years, and it was for a long time, at least appeared to me, to be free money almost. It's just about riskless principal trading. There's increasing pressure to make those more transparent. A number of our clients, we're helping more of our clients do sort of an agency-based currency brokerage model. And as those things happen, I think maybe you'll see some of the, that's one area where, particularly in this market with so many perceived imbalances in currency rates, you might see more opportunities for funds and agency-based strategies to go out and exploit some of these imbalances. As money goes into those, it's going to open up a whole another set of these questions around what is the operational infrastructure that you need, and do the vendors or the managers that you're using really understand the markets that they're operating in, because they've been opaque for so long.